What is the venture capital method of business valuation? Well, quite simply, this is the method used by venture capitalists to determine what percentage of a company they are going to purchase in exchange for their money. Now, once the investment decision is made, the investor will look at the investment and determine what multiple of their investment they require as a potential return in exchange for this level of risk that they are incurring by investing. You see, venture capitalists invest in high-risk ventures, startup ventures, and because of that, the majority of their investments are going to fail. Let's say 6 out of 10 of them fail. 1 will break even and 3 will make money. Well, of those 3 that make money, they have to make a certain amount of return to justify losing their money on the other investments. With that being said, they look at the particular investment, the nature of it, and say what type of return would they need on their money to make their portfolio investment round out. So that if this is a very risky venture, they may need 20, 30 times return on their money. If it's a normal high-risk startup investment, they may need 10 times their money at harvest or whenever the business is ultimately sold or their interest is sold in the future. So they're looking over a 3 to 7 year timeline. And so what they do in this scenario is they look at the final value of the company, the terminal value of the company, right? And then they divide that by their expected rate of the return. So if the terminal value of the company is $100,000 and they need 10 times their money, well, the terminal value of the company then is $10,000. And if the company needs $2,000 investment from the investor to grow to this future value, then the investor says, okay, the terminal value at my multiple is $10,000. They need $2,000. I need 20% of the company in exchange for my $2,000. And then ultimately, when the company reaches its valuation, I'll still own 20% of the company and I'll receive 10 times my money. Now, one issue that comes up here is that oftentimes venture capitalists get diluted in terms of their ownership percentage. Maybe not dilution in terms of the value of their shares at any given point in time, but in terms of the value of or the percentage ownership in the company that they obtain. So they may negotiate a preferred share that has an adjustment ratio in it that makes sure they're not diluted in future rounds. That is, their conversion to common shares simply tracks a given percentage of the company. And this is a major protection for a preferred shareholder. But this venture capital method is one of the more common methods used for again, startup valuation, because oftentimes these investors are investing for a specific period of time before the next round of investment is needed. So they're looking at the valuation potential for that at that next round, and as such they require a certain multiple of their money during that time. They can simply extrapolate on that, divide the terminal value or that value at the next funding round, divide it by the multiple they need. That's the terminal value of the company. Whatever they invest represents a percentage of the company at that time prior to the next round of investment. And there you go. That's how, again, their investment percentage is calculated. So that's the venture capital method of business valuation for purposes of determining ownership interest for amount of money invested.